This is the Asia Trade. I'm Shery in Tokyo.
I'm Haidi, Stroud-Watts in Sydney. The top stories this hour. Asian stocks are facing a lower open after a weak 10-year Treasury sale wipes out Wall Street's gains, underscoring the current fragility of global markets. BHP is said to be seeking buyers for the Brazilian gold and copper mines it acquired in the takeover of Oz Minerals. Plus, exclusive insight on the Adani Group's infrastructure ambitions as we ask one of its next generation of leaders about the impact of those Hindenburg short seller allegations.
I think it was definitely personally speaking, a very stressful and tough time. Emotions were high.
Really, Heidi, volatility is the name of the game, isn't it? The market gyrations just globally. And if you ever thought that Japan was a beacon of stability, well, that's no longer the case, right? It's really not been the case in the past year with the rapid depreciation of the Japanese yen against the US dollar. But now we have this immense volatility with that recent rally. And again, we're down in the Japanese yen because we heard from the deputy governor of the BOJ talking about really not hiking rates again until markets stabilize. So that really sent the yen weakening in the previous session. So we'll continue to watch those gyrations today.
Yeah, and I suppose the question is really, this is new ground, right? And as one investor said, this is a lot of soul searching going on with the BOJ kind of hell-bent on making its way through this new landscape with this new policy narrative as well. But we're also, of course, watching any further signs of weakness when it comes to the US macro picture as well, because it's not really just about domestic US growth. It's how much it could potentially imperil the rest of global growth, including the economic recovery that we're watching very closely when it comes to China. And in fact, when it comes to those export numbers, that worst trade outlook is a growing risk for China as its own domestic sentiment and spending continues to wane. The July China export growth numbers was an unexpected slowing when it comes to dollar terms. So this kind of big export engine of growth, so vital for keeping that 5% target for GDP within reach, now seems to be coming under threat, largely in part by signs of declining US demand, just as, of course, a lot of that domestic weakness continues to be unabated in China.
And really, exports were that rare bright spot for the Chinese economy, right? But we're not just talking about China. We're talking about all of these Asian exporters that, of course, send products to the U.S., including Korea, Japan. Take a look at A50 futures in China ending under pressure at 0.25%. And, of course, we continue to watch Nikkei futures. We saw gains for the last two sessions, given, again, the weakening trend of the Japanese yen. But we are watching the reactions from SoftBank's earnings, not to mention that they announced a buyback as well. Also, we have Tokyo Electron reporting today. So we are watching those numbers together with the BOJ minutes from the last policy decision out today. The ASX 200 futures also down and under pressure. But take a look at how U.S. futures are coming online in the Asian session, because we had pressure in the overnight session. We're talking about those big tech leading the declines, NVIDIA, one of the biggest losers, and really to do with that weak Treasury auction that we saw. Perhaps I'm thinking that the bond rally that we've seen recently has been overdone, a little bit of profit taking as well. What's key to watch from now on is eco data, including jobless claims numbers on Thursday and another Treasury auction on Thursday as well, Heidi.
And it feels like at this point, Shery, every one of those, singular events that we may not have paid that much attention have you with us. And does it feel this way to you that this is sort of, a new normal in the sense of how fragile global markets are really across asset classes? What are you watching for? And I guess, how do you characterize the investment environment over the past couple of days to now?
Yeah, I think, the one important thing to keep in mind is that a median drawdown in the S&P over its history of 50 plus years is anywhere between 10 to 13%. And the beginning of the year, we had only a 5% drawdown. So it's really normal to see an annual drawdown. Even with the current leg down, we were down only about 9%. And we've recovered a little. So I think we have to keep that in mind, that, the markets have run up so significantly and we could have a correction. And secondly, I think that there is things are getting blown out of proportion at every reaction, given the volatility trades and given all the quant trades out there. I do think that this slowdown in the U.S. economy, which we were expecting, is definitely happening because we come from a high base and some of the fiscal drag is done. But I think the market sentiment swinging to a recession with the SAM rule, et cetera, getting triggered, I'm still not in that camp because I think there are enough resilient factors in the U.S. economy. So recession is just more of a tail risk rather than a high probability scenario. And this convergence trade, which is all this divergence that was happening by the big mega cap tech, the extreme concentration, that divergence trade from the rest of the market seems like that will be converging now. So other pockets of the market, whether it's the equal cap index or the small cap, I think there are other opportunities also that are looking interesting. So I'd say an annual drawdown is normal. I'd be very discerning within the tech space and just view what's happening with the numbers and the results and kind of positioning X mega cap tech within US, but even looking at opportunities internationally.
Yeah, and if I'm correct, you sound sort of perhaps a bit more bearish than what we've been hearing when it comes to broader AI and tech, right? Because as you point out, no, the CapEx spending has not been anywhere close to invested returns for AI. But we also knew that it was one of those things that, I guess these investors are grappling with now, but that's kind of always been the fundamental of this trade. Do you have sort of bigger questions about how this materializes in terms of value in the years and potentially decades to come?
Yeah, sure. So I'd say a couple of things from the recent results. One is there's been huge capex, obviously, by the hyperscalers. The question is the return on invested capital for this capex, right? That's the key question going forward, which will justify the higher valuations. And also, what is the uptake of all this capex that is being spent by the enterprise and who's going to use it, deploy it, enhance productivity. So those are some of the critical questions, and it's been a mixed bag in terms of what we see out of the earnings. Is this going to be 99,000? Clearly no, because at that point we have a lot of indebted companies. Now you have cash flows, you have yield. So there's a big difference between that. So I don't think the NASDAQ correction is going to be to that extent. Right. But can all these stocks be the relative outperformers in the next 2 years? Maybe not all of them. I think we really need to get discerning. And that's what I'm thinking through, think about this.
What do you think of the tech names then in some of these Asian economies? Because we know that really when it comes to Korea, Taiwan, for example, they have really these tech giants that make up a big chunk of that market.
Yes, so I think they are clearly, linked and high beta to a lot of these, the AI ecosystem because of the raw material they provide to the data centers. In our analysis, we are still fundamentally a couple quarters away from that peak. If there was one metric I track, it's the data center capex, because that kind of really lifts, the businesses of these companies. The capex of the hyperscalers are the profits of the emerging market tech names in Asia. So from our analysis, we are still 2 to 3 quarters away from that peak in capex. But again, there are different cycles. Which is, in Korea, it's the DRAM cycle. We see that also inflecting now, which is more linked to the iPhones and the PCs, which was not part of the first run that we saw in semis. Right. So, I'd say we are fundamentally still positive in those areas, but of course not to the extent of being extremely overweight. We haven't had that stance in portfolios.
Because especially if you continue to see this immense volatility in the Japanese yen, right? I mean, what was interesting during this yen short unwind and we saw this immense rally was how correlated the Japanese currency was to the Philadelphia Semiconductor Index, for example, even more than the Japanese topics. But let me ask you about the implications of this carry unwind when it comes to, say, other emerging markets. The yen weakness overnight sent the Mexican peso rallying.
Yes, I mean, again, it's, all those linked trades with volatility products, quant products, and the unwind. I do feel like a large part of as much as I'm a believer of stronger yen at 155 levels, the yen looked extremely cheap. Who knew that it'll react in this manner? I do think at this stage, the move has been pretty significant on some of the technical indicators. So I would think that some of this dust settles down in terms of the carry trades and the implications. And, a lot of these currencies have also fundamentals, whether it's the Brazilian real, the Mexican peso, in terms of real yields still being high from a currency and emerging market debt perspective. So I'd be a little more fundamentally driven, and I think that flows can overwhelm in the short term, but the fundamentals will stand firm in the long term.
Jitania, Kandhari, always good to talk to you, Deputy CIO at Morgan Stanley Investment Management. And coming up on the Asia trade, hear why K2 Asset Management is seeing risk-on opportunities in the coming months. We'll also digest SoftBank's earnings and buyback with Astris Advisory Japan. Plus, our exclusive conversation with Indian billionaire Kweichow Moutai's youngest son, Jeet, who oversees the airports and defense businesses of the $123 billion conglomerate. This is Bloomberg. Take a look at how we're setting up for the market opens across Japan. Of course, we had that incredible volatility when it comes to the Japanese yen and that weakening overnight that actually led to some gains in the stock markets for a second session. Right now, we're setting up for perhaps losses at the open with Nikkei futures down 0.7% and the Japanese yen now strengthening a little bit against the U.S. dollar, that 146 level. And of course, all to do with some of the dovish signal that we're now seeing from the Bank of Japan after the deputy governor came out and said that the bank wouldn't raise rates as long as markets are unstable. Not to mention that it's a busy day also for earnings, a busy week. We'll be watching SoftBank shares when Japan opens after ADR surge following news of a $3.4 billion buyback. The company also says it's gearing up for more aggressive investments in the AI space. Technology reporter Min-Jung Lee joins us now for more on this. And Min-Jung, this surprise buyback, what made SoftBank decide on this, something they haven't done since 2022?
Right. A lot of people didn't see that quite coming because the message from SoftBank, including those from Masayoshi Son himself, had been that it's time for SoftBank to invest rather than spend money on buybacks. But I think what had caught everyone off guard, as you know, is the market crash that we saw through to Monday, which actually prompted the buybacks. An activist investor, Elliott, did ask for buybacks prior to this, but CFO Goto told the audience yesterday that SoftBank is never swayed by requests from a single investor, implying that it wasn't Elliott that made them take action. And as for further buybacks, he said we'll really have to see how the market moves going forward.
And a surprise earnings loss. What does this tell us about the broader outlook for SoftBank for the new fiscal year?
Right. It was the Vision Fund, again, that weighed on the bottom line. There were declines in the values of some of SoftBank's public assets, which led to an approximate 200 billion yen loss in the Vision Fund. And with the current environment making it extremely difficult to anticipate a strong market rebound, we may be in for a few more difficult difficult quarters. But given how quickly market sentiment tends to change and how volatile the moves has been, I think we really have to see how things pan out. One bright spot is ARM, which reported solid earnings, although the guidance was disappointing to some. So how ARM performs business-wise and their share price also remains key.
Yeah, especially at a time when they're still saddled with hundreds of loss-making startups, right? Did we hear anything else about potential investments in the future?
Right. Investments are really important and the center of attention for a lot of people. So CFO Goto actually spoke a fair bit about SoftBank's new ambitions into artificial super intelligence, how the three key areas for them include chips, robots, and data centers. And the group did directly invest in $1.2 billion worth in startups, while the Vision Fund also made about $600 million in new investments in the first fiscal quarter, including companies like GraphCore and Perplexity. So I think we can anticipate some more investments going forward, but I think this also kind of hinges on how the market performs going forward.
Our tech reporter Min Jung-lee there joining us with the latest on SoftBank earnings and investment plans. Now, Tokyo Electron is another stock that we'll be watching today. It may report higher quarterly operating profit from rising revenue, benefiting from robust demand for artificial intelligence. Bloomberg Intelligence technology analyst Masahiro Wakasugi joins us now for a preview of the results. Masa, what are we expecting when it comes to these numbers?
Yes, we think that Tokyo Electron's revenue should be growing pretty strongly. And their revenue guidance for the first half is around up 20% or 22% year over year. So maybe probably the first quarter revenue should be growing around 20 or 20 something percent. And if we look at the Lam Research, its peer competitor reported the June quarter revenue up around 20 or 21% year over year. So we think that probably Tokyo Electron's demand for the chip making equipment pretty strong and revenue growing that kind of high numbers.
We were speaking earlier in the show about the potential issues with the Chinese economy achieving the 5% growth target if we actually see some slowdown in the U.S. economy. What are we seeing in terms of demand from Chinese customers when it comes to Tokyo Electron?
As far as we see the demand from China, we are hearing that Lam Research or Screen Holdings, many chip-making equipment companies are saying that demand from China will remain pretty solid going forward because they are focusing on the chip development and quite aggressively. So probably maybe regarding chip making equipment demand in China, it will remain pretty solid going forward. And we think that the revenue exposure to China for Tokyo Electron or maybe some Japanese companies will remain between, say, 40 to 45% out of total revenue going forward over the next few quarters.
What about when it comes to the exposure to, say, the Biden administration's restrictions against China when it comes to these chip-making technologies?
Yes, if we have further restrictions, the revenue exposure could come down a little bit. But when it comes to the Lam Research or Applied Materials revenue exposure, it's still around 40% out of total revenue. So if we apply the similar restriction on both Japanese companies and US companies, the revenue exposure should be pretty similar for everybody, I think.
Bloomberg Intelligence Asia Pacific technology analyst Masahiro Wakasugi there. Well, BHP is said to be planning the sale of the Brazilian copper and gold assets it acquired as part of its takeover of Oz Minerals. Bloomberg's Paul Alan Joyce is now with the details. So what do we know about this plan?
Not too many details, unfortunately. This comes from Bloomberg reporting, speaking with people familiar with the matter. So there's no official comment from BHP, no comment also from Banco Santander, which we understand BHP is engaged to see the sale through. But the timing does kind of add up because it was last September that BHP says it was conducting a review of these assets that it got from its takeover with Oz Minerals, and it said that it would take about 12 to 18 months from the date of acquisition. That was May 2023, so we're firmly in that window. So in the sense of timing, it would make sense that there are now questions around the future of these Brazilian assets.
Does this fit with the broader strategy in terms of what we knew they might do?
Yeah, the timing makes sense, but the strategy, maybe we need to join a few more dots here, because BHP said it wants to focus on minerals that are critical to the energy transition. Hello, copper. That fits obviously within that remit. So these 4 copper mines, there are only 4. They are small, but they are high grade. The gold deposit, meanwhile, is untapped. So it'll be interesting to get some more detail from BHP if indeed they do confirm that these assets are for sale, and if so, why. BHP is going to remain in Brazil more broadly. However, it's previously said it's got no plans on selling its stake in the SMIC iron ore business. It's still, of course, dealing with compensation issues around that related to the 2015 dam collapse, but it's previously said it's going to stay in the iron ore business, but this sale and this question really only deals with those copper and gold assets.
Well, Alan here in Sydney. More ahead on the Asia trade. This is Bloomberg. Taking a look at some of the corporate headlines that we're tracking this morning. DBS says Tan Su Shan will success Piyush Gupta as CEO when he retires in March, becoming the first woman to lead Southeast Asia's biggest bank. Tan currently heads the lender's institutional banking group and has now been given the additional appointment of deputy CEO. She's been credited with expanding DBS's consumer and wealth businesses. Novo Nordisk's US shares closed lower after disappointing sales of its weight loss drug Wegovy. Second quarter sales of $1.7 billion fell well short of estimates. Revenue from the drug was hit by higher than expected price concessions in the competitive US market. The size of the shortfall raises concern about growing price pressure from rival Eli Lilly.
The second quarter is a quarter where Wegovy came in a bit short of consensus, and that's linked partly to some adjustments in how we accrue for rebates. So I would really urge investors to not just look at the quarter in isolation, but look at our confidence in the rest of the year and the upgrade we are bringing.
Disney is forecasting a mid-single-digit profit decline in the fourth quarter. The company reported mixed third-quarter results, with weakness at its theme parks offsetting its first-ever profit in streaming. Disney sees pressure in park attendance lingering for the next few quarters after previously predicting a rebound in the final months of 2024.
The lower-income consumers are a little bit stressed and shaving a little bit off of their time at the park. And then higher-income consumers are tending to travel overseas a little bit more right now. So we really just see this as a few quarters of slight perturbation in the numbers. Frankly, I think we're going to be right back as we get into the middle of next year.
Warner Brothers Discovery shares tumbled in late trading after second quarter results missed expectations. The parent of CNN posted a charge of $9.1 billion after writing down the value of its traditional TV networks. The firm has concluded that cable channels are no longer worth what they were in 2022 when Discovery acquired Warner Media. More ahead on the Asia trade. This is Bloomberg.
The markets are often wrong about what's going on with the economy and what the Fed is going to be doing. There is some significant, evidence of some slowdown of the economy, but I don't think the data suggests that we're going to have a hard landing anytime soon. If anything, actually, there's some elements of strength in the economy.
Rubini Macro Associates Chairman and CEO Nouriel Roubini speaking to us about U.S. recession risks. And it's time now for morning calls ahead of the Asia trading day. JP Morgan CEO Jamie Dimon says he's skeptical that inflation in the U.S. can return to the Fed's 2% target. He told CNBC there's still a lot of economic uncertainty tied to factors including geopolitics and quantitative tightening. Dimon has been warning for more than a year that inflation may be stickier than investors expect and says his bank is prepared for rates ranging from 2 to 8% or more. Meanwhile, JP Morgan economists say they now see a higher chance of recession in the U.S. by year-end. They've raised the odds to 35% from 25% last month. The team says recent data suggests a sharper than expected weakening in labor demand and early signs of job shedding. JP Morgan's call follows that of Goldman Sachs, which now sees a 25% probability of a recession in the next year. Haidi.
Well, Shery, Goldman Sachs strategists think US yields are too low because there's little evidence of labour or financial market dysfunction. They add that a meaningful rally can only happen if one or both of those risks materialise. US Treasuries are under pressure after investors spurned a sale of 10-year notes that offered at lower yields. Well, the former New York Fed President, Bill Dudley, says the Fed is contending with contrasting economic data and needs to consider a shift in both policy and messaging in the coming months. He told us more about the balancing act that's facing policymakers.
A couple things. Number one, we've seen a rise in unemployment claims. We've seen a drop in the hires rate. We've seen a drop in the quits rate. It looks to me like the labor market is cooling off quite significantly. We've also triggered the so-called SOM rule, where if the unemployment rate rises by more than 0.5% over a 12-month period, every time that's happened, we've ended up in recession. So there's a lot of risk out there to the downside in terms of the labor market. On the other side of the mandate, the inflation news has been very, very good recently. So it seems to me that the Fed needs to hold both sides of the mandate with equal weight right now, and that implies that monetary policy should be neutral, not restrictive. And we're a long way from neutral. I mean, people don't know exactly what a neutral monetary policy is precisely, but nobody thinks that 5.25% to 5.5% federal funds rate is consistent with neutral. Probably somewhere in the 3 to 4% range is where the Fed should be.
Bill, you've had an enormous influence on how people are thinking on Wall Street about what's ahead. So I want to ask you, if you think an immediate rate cut is not on the table, that they won't move into meeting, what would you recommend they should do in the next few weeks?
I think what they should do is change the messaging a little bit and make it very clear that they're now focused more on the labor side of the mandate, get the market attuned to the notion that if we get weak data over the next 6 weeks, that 50 basis points is highly likely at the September meeting. You can put 50 basis points firmly on the table if the data flow continue in the same direction.
Former New York Fed President Bill Dudley speaking with his fellow Bloomberg opinion columnist Mohamed El-Arian and Haidi. Seems to be that really it's the pillars that underpin the market rally in recent years that have been completely shaken to the core, right? I mean, with weaker than expected U.S. jobs data, not to mention that the BOJ hiked rates as well. Really that idea of U.S. supremacy when it comes to the economy, markets, not to mention that Japan would never really tighten. That's all gone out the window. So we have seen this momentum bets that were really the key to the markets in the past year sort of all backfire at once. Quant funds that chased the hottest trades on Wall Street really getting pummeled, and the year's big trades that stocks continue to rally and so on have all been shaken. And you can see this Societe Generale CTA index now going back to levels where it started this year.
Yeah, and it's interesting, this kind of trend-chasing strategy, which, when you take a look at it, is almost by design exposed to rapid shifts in sentiment. It's unsurprising that this is now the reaction that we see, right? As we spoke to Dynamic Beta Investments saying everything went wrong at the same time. And as you mentioned, Shery, I think some of the seasonality stuff, this isn't typically a great time of year for US risk assets. We know that there were some risks going into this part of the Fed cycle and other central bank cycles, but it feels like Japan has really kind of been the wild card here, right? We had the AI euphoria fueling that bull run, but then the yen was suddenly deflated. The yen was so deflated, but then that reversal, as we saw that earlier than expected and, more aggressive than expected approach by the Bank of Japan.
Yeah, take a look at how assets are setting up across the Japanese markets, because, of course, we had that incredible weakness in the last 2 days after that rally in the Japanese yen on Monday. Right now, we're seeing, again, some gains at that 145 level, but really it's all about volatility, right? Some soul searching going on right now among traders and investors, especially after we got also that dovish BOJ signal overnight. For more, let's bring in Asia Economy and Government Senior Editor Brian Fowler here with me, and really those comments by Deputy Governor Shinichi Uchida yesterday daytime, and you saw the yen just weaken again. What exactly did he mean? Is he backtracking on what the BOJ has done? How should we really try to understand what they're trying to do?
Yeah, I mean, the new thing that Uchida said is all pertains to what's happened in the last few days in the markets, and that's simply that if markets are going haywire, the BOJ is not going to hike rates again, and that's just because the central bank, above all things, wants stability. As you said, it does not want volatility. Beyond that, though, not a lot has changed. And let's remember that the BOJ's mandate was never to keep what some would call a stock bubble inflated. That's not its mandate. Its mandate is stable inflation near its target. And so one of the problems was the weak yen. With the rate hike last week and with hopes that, or expectations that the U.S. is going to cut rates maybe in September, the yen has started a correction. It probably has further to run. Dollar's down about 6 or 7 yen from where it was when the BOJ hiked. That's a good thing. It did chase some speculators from the market, but again, the BOJ's mandate is not to make things comfortable for speculators. It's stable inflation. So I think if you were to talk to the BOJ officials right now, probably in private, they might not want to say this on the record, I don't think they would be that concerned with how things have gone. I think they wanted to see the yen correct, and they probably would say that the stock price stuff is maybe just a slightly healthy correction and probably not some kind of permanent spiral or anything like that. So I don't think it's a reversal. It's just an acknowledgement that volatility is not welcome.
Because it's been really interesting to see the reaction in the equity markets and the Japanese yen on Monday. You saw the yen rally, the stock market take a plummet, and then on Tuesday you actually sort of coming back to levels where we were before. So it seems almost that we're back at those levels that we started at the end of last week. At the same time, though, given what has been said around the BOJ, especially after the rate hike in the financial markets and that criticism and backlash on the BOJ potentially having done too much. And right now, also, there have been comments that they're capitulating, that they're retracing what they did, that they caved to market pressure. Where do they go from here?
Yeah, so I think, Uchida said no hikes when there's market turmoil, and that makes sense. He also said he thinks things need to stay accommodated for now. But let's also remember that even with the hike last week, monetary conditions in Japan are still very easy. Even if they hiked again to 0.5%, that would be very easy by global standards. So he said yesterday, and this is in line with what Governor Uchida said after the rate hike, if inflation and the economy continue to move in line with forecasts, there will be another hike. The way he phrased it, though, was that the degree of easing would be moderated more. In other words, there'd be less easing. So he's emphasizing that policy is easy and will stay easy even if there's another hike. And so I think in that sense, and if you ask economists, and we surveyed them just 2 days ago, they're still of the view that before the end of the year, there could be another hike. It's not going to be, obviously, probably not in September, might not be in October, but at least by December, the BOJ is probably going to go back to 0.5%.
I'm looking forward to those BOJ minutes to be released in the next few minutes. Our Asia Economy and Government Senior Editor Brian Fowler here with his take on what's happening around the BOJ and the Japanese economy. This is Bloomberg.
Let's get more now in our exclusive series on the next generation of leaders being groomed to run India's $213 billion Adani Group. Jeet Adani is the youngest son of the conglomerate's founder, Gautam Adani, and heads their airports and defence businesses. The 26-year-old was a relative newcomer when short seller Hindenburg's allegations of fraud rocked the group last year. We asked him how that period impacted him and his family.
Jeet Adani is the youngest son of Indian billionaire Gautam Adani. As part of the tycoon's succession plan, the 26-year-old engineer is overseeing the running of 7 airports across the country, including the one in India's financial capital, Mumbai. The Adani Group is also building a brand new airport for the city at a cost of $2 billion. Along with airports, Jeet is responsible for the defense business, while also looking after the group's digital initiatives. The youngest of the next generation of Adani leaders is being groomed to run big parts of an empire that's been rocked in recent years. In early 2023, just a few years after Jeet joined the family business, a report published by short seller Hindenburg Research accused the company of fraud and share price manipulation. It sparked a $150 billion meltdown in shares of group companies. The Adanis have denied the allegations, and their shares have recovered, but they're still dealing with the fallout. Bloomberg's Anto Antony spoke exclusively with Jeet Adani and asked him how the group's strategies have changed.
You had just joined the business when the Hindenburg report came out. How did it affect you personally, and what role did you play in that crisis situation?
I think it was definitely, personally speaking, a very stressful and tough time. Emotions were high. But I think the most important thing that was on my mind definitely was, what can I do to support, obviously, the family? But more than that, how do I support the larger family, which is the employees? Because the biggest risk that you run in times like these is demotivation, people sort of losing hope, and to make sure that everyone is motivated, everyone knows that what we are doing is for a greater purpose, it's for we're making real impact, and we continue day on with the work, because these things, they happen, they come, they go. But we don't want to lose motivations.
Some of the investigations or probes or allegations are still an overhang on the group. How are you assuaging the investors' concerns in these times?
So I think, and this is based on some of the interactions that I've also had with investors over the past couple of months. I think there's a clear understanding with the investors that, with the Hindenburg report, everything that was said and allegated against us was sort of just rehashing old things again. And a lot of investors really appreciated the kind of communication that we've done over the last 18 months. At the end of the day, not a single investor's query will be left unanswered. We were proactively reaching out to investors after each and every report or article or anything that was coming out. And with all the performance from the financial side also, they were very clear that, look, this is a very good asset. All of the companies, they have strong infrastructure assets, and the leadership team has given us enough confidence by communicating with us enough. I think that's kind of helped actually investors to realize that, to look beyond this and actually look at the asset, look at the leadership team, what kind of cash we're generating, and what kind of growth we're doing.
You're overseeing construction of a $2.1 billion airport in the outskirts of Mumbai. Now, as I understand, the phase 1 construction is on time. However, my question is it too little too late? Because the way at which the expansion, the aviation market in India is expanding, would you have to work on the remaining phases at a much faster pace than earlier envisaged?
No, absolutely. I think you're right. If you look historically, when the initial privatization of both Bombay and Delhi happened together in 2006, Bombay as an airport was actually larger than Delhi. And it was growing at the same pace as Delhi was growing, but it hit a roadblock because it has a capacity limitation, being a single runway airport. And Delhi kept growing. It's now about 75-80 million passengers per annum. The latent demand of Bombay as a city is not stopped growing. People still want to fly. The ability to consume, ability to spend on travel is still very, very high and is still growing at the same rate. It's just that they don't have the option, or they don't have the infrastructure to be able to take flights. So definitely, when it comes to your question on too little, too late, yes. The good thing is we're getting there. Based on the initial conversations and what our forecasts are for the first year itself, once we start operations, we'll be pretty much exhausting 60-70% of the capacity of the new airport. And given that it takes anywhere from 2.5 to 3 years from start of a new project to commissioning, we will immediately need to start phase 2 of another 30 million passengers as soon as we finish phase 1.
You're overseeing the group's defense business. Now, India is a country with the world's second largest standing army. What scope are you seeing in the sector and how are you going about it?
We primarily are focusing on areas where we think we can make a significant impact. That's why we're not chasing large capital projects like submarines or fighter aircraft, which we were in the past, but we've sort of redone our strategy now. Our strategy is focused on three things. The first thing is around unmanned systems, so unmanned aerial vehicles, ground vehicles, water and submarine vehicles. Our first milestone we hit earlier this year when we delivered the first drone to the armed forces. This was a male category drone. We have the capability to actually manufacture and design all the way from male category to micro rotocopters, which, small copters, you can use it for agricultural purposes as well. The second area around our defense ecosystem is on small arms. Small arms is very important because we see that based on the current equipment that the Indian armed forces have, a lot of modernization needs to happen. And we're very lucky that, we've been able to win contracts to supply to them with an indigenization number of over 80%. And our target is by the end of the contract, we want to hit to 100% levels of indigenization. So the entire value capture will happen within India. And the third part of our portfolio around defense is on ammunition. We are the only private sector ammunition manufacturer in India. On the small caliber side, we manufacture, and it's up and running already. We'll manufacture over a couple of 100 million rounds a year, which will be able to serve about half of the current yearly needs of the Indian Armed Forces. And we're also expanding into medium and large caliber. So that sort of ties up the entire portfolio. Definitely when you look at scale, once all of this is up and running at 100% capacity, this will be a very large scale business in itself. As we actually are building out this capacity, we're also looking at new opportunities around defense where, cybersecurity, looking at systems, mission systems, not just manufacturing as an OEM, one drone or one equipment, but actually tying the entire thing together into a battlefield mission system. That's sort of more future looking, and then you have what we're manufacturing today.
So at this young age, you are running some of the big businesses in the region. At the same time, the chairman, who is in his early 60s, an age at which many people contemplate retirement, is putting in 18-hour work days. Do you think he feels confident, or you as G2 feel confident that if he decides to take a break, the G2 will be able to handle the businesses?
Yeah, I think on a lighter side, I don't think he's going to be taking a break anytime soon. For us, when we sit together as G2, the most important thing around this is self-realization. I think we all realize as a group of 4 of us that put together our capabilities are not going to be able to match up to his, because he's is a once in a generation kind of entrepreneur. But what we can do better is, with the access and resources that we have, how do we train ourselves in aspects that we can control better? And we've identified, on being successful, you need 3 things. You need the right people, you need to be able to handle the right people, and then you need to manage risk. If we're able to do these 3 things as a family successfully, definitely we'll be able to grow. I don't think all of us are there yet in terms of capability on these 3, but this is where we're working with the right mentors to train us.
Jeet Adani, the youngest son of Indian billionaire Gautam Adani. As we're getting breaking news out of Japan, we are now getting the June current account surplus coming in at 1.534 trillion yen. The estimate was for 1.9 trillion yen, so it's really narrowing more than expected. Of course, we have seen this surplus being supported by smaller deficits in goods trade, not to mention travel services. Of course, we have an increase of foreign visitors to Japan, but we are now seeing that number moderate in June, with the current account surplus now coming in at 1.5 trillion yen and narrowing more than expected. This is Bloomberg.
We are just getting that Bank of Japan summary of opinions and, of course, closer scrutiny, given that we saw that unexpected move from the Bank of Japan, which at least in part triggered so much of this global volatility. We're hearing from one BOJ member that the neutral rate seems to be at least 1%, that prices and growth are developing in line with the broader outlook. We're also hearing that that rate of change in import prices has turned positive again. The upside risks to prices now require attention. To that point, it was decided appropriate for the BOJ to raise the policy interest rate and adjust the degree of accommodation in monetary policy for sustainable and stable achievement of the price stability role. We're hearing that one BOJ member really noted the need to monitor the data to see the gains that we've seen in the wage gains increases that we have seen, Shery.
Yeah, that's interesting, right? Because we have seen really wage growth turn positive for the first time in 27 months. Just recently, one BOJ member also talking about prices and growth developing in line with the outlook. And that line is very important because it sort of signals more tightening to come. The BOJ had said that they would be very data dependent. So if data kept with the outlook, that they would be able to, of course, hike rates. But of course, we saw that dovish signal also coming from the deputy governor just yesterday, saying that the bank wouldn't raise rates as long as markets aren't unstable. So we're really trying to figure out where the BOJ is standing in further hikes to come this year. BOJ member noting that the nominal rate is at 0.25% and is still extremely loose. That normalization shouldn't be an end in itself. Interesting in the minutes that I'm looking at right now that although private consumption has not been so strong, according to the release, it's likely to remain resilient. Of course, private consumption, Haidi, has been really important for this economy, for the BOJ to be able to hike rates.
Yeah, and Shery, we keep asking the question as to whether that virtuous cycle of growth and consumption has taken hold yet. And it's interesting, this dissenting voice in those minutes saying that there's little data confirming sustainable growth in the economy at this point. The bank should decide on changing the guidelines for money market operations after assessing key eco data of the next meeting. So very interesting that it's not sort of unanimous when it comes to that decision. Taking a look at the setup as we head into the start of trading in Sydney, Seoul and Tokyo, or looking a little bit weaker.
This is the Asia Trade. We're counting down to Asia's major market opens after that pressure that we saw in risk assets on the Wall Street session after a weaker than expected Treasury auction. And of course, Haidi, right now we're still digesting those BOJ minutes from their latest meeting when they actually hiked rates and cut bond purchases. Interesting to me, one member saying that prices and growth are developing in line with the outlook, but one member also saying that little data is confirming sustainable growth.
Yeah, that dissenting voice is quite interesting because we've talked at length about whether or not the sort of deflationary mindset has really lifted and transitioned into more positivity and confidence, right? Certainly some domestic weakness there, but it really does feel like Japan is sort of still at the epicenter of where we go next with these markets.
Which is why we're really trying to digest and understand what the BOJ is thinking, right? Yesterday, we had the deputy governor of the BOJ talking about not hiking rates if the markets were unstable. We're seeing right now a little bit of pressure overall in the equity markets and strength on the Japanese yen as well after we saw weakness following that more dovish BOJ signal coming from the deputy governor. So a lot of volatility, just suffice it to say at the moment. I mean, we have seen this incredible depreciation of the Japanese yen this year in order to see that rally, then depreciation again, just to be higher by 1/3 of 1% in today's session, but it's still early in the morning, and we do have another 30-year auction here in Japan. So we'll see if we continue to see that pressure higher when it comes to JGB yields as well. Take a look at how the Kospi is also coming online. Of course, we had a better day for South Korean stock markets as well, really being led by Samsung on reports that NVIDIA's tests had been passed by one of its advanced chips. Right now, though, losing ground by more than 1% and some weakening on the Korean won, Heidi.
Yeah, take a look at how we're setting up when it comes to the staggered session here in Australia. We did see some modest gains in the previous session, but looking like a bit of weakness here as we get into the start of the session, about 0.1% lower there. We're watching the likes of BHP as we hear about their potential plans for some of these copper and potentially even iron ore assets as well. We're also watching the Aussie dollar, pretty unchanged at the moment, 65.19. Of course, so much of what we've been seeing overnight has been that slide in treasuries, investors really shunning that 10-year sale at those lower yields. The climb globally, though, as we see this kind of recent bond rally continuing to come a bit apart here, and you're seeing yields remaining modestly sort of steady at this point. Also watching oil, that recovery rally had been sort of extended as we still await for some of those further geopolitical developments in the Middle East, the biggest advance in about a week that we've just seen. Well, next guest is opportunities for investors. Once again, carry trade unwinding works its way through and markets consolidate. George Barbaros is the Managing Director for Research, Investments and Advisory at K2 Asset Management. I guess the question is how much further this unwinding has to go and how painful the rest of this process is going to be, right?
Spot on. And obviously the magnitude and the severe volatility seen earlier this week was quite extreme, and obviously unwinding the carry and all those short vol. A way to look at it very quickly is that it hasn't escaped us. The severity that we saw on Monday, we'd say, is behind us, but the risks are still there. Effectively, all investors, we've had a one-way bet with yen weakening from 110 right up to 140, 150, 160, and that had to be unwound to some degree. Obviously, the new shorts from Monday's session and those low 140s, they can play out. You'd think that the yen can weaken and reverse some of that into the 150 level. But the point is there's still carries and leverage in the system, and there's still significant shorts and volatility. It's just that the system won't have as much as what was in the system, say, going into that Monday extreme vol and what happened across the world for that 24-hour period. So the risks are still there. But let's take a step back. The BOJ, and this is not meant to sound like an odd statement, they're finally getting some nominal consistent rates in the out years with that look, and that's what they've been trying to get there for many decades. So they've done it in a significant manner, but it's been slow, measured, very measured and steady. And Ueda and their team obviously are using the local press in Japan to give some hints here and there, but generally it's reasonable policy because they also are big owners of equities in Japan.
And George, we're taking out that volatility chart, right, both when it comes to Nikkei Volatility Index and that top panel, the bottom is the dollar-yen 1 month, and both very much above normal. And even this morning, you're seeing that slide in the topics to add to the recent sell-off. Are you surprised that value investors are not coming in at this point? And I guess does the uncertainty over the Bank of Japan and the real shift in narrative and trajectory here for the BOJ, does that change the risk and appeal of Japanese assets? Where do you look for opportunities at this point?
Yeah, so very quickly, value investors, that was a calendar 2023 story for Japan, and they really haven't been participating in that growth recovery of the earnings cycle and obviously that yen weakness. Where the opportunities very quickly is that let's just try and get through this volatility event. It's again, the severity, we think the worst is behind us, but there's still people short or leverage and still short yen, and there's still people short volatility, but not to the same magnitude. I think if you take a step back, when it consolidates in the month ahead, Nikkei is a reasonable earnings environment to be accumulating from a growth perspective, not a value play, and that's on a one-year view, looking at the volatility. And the same could be said for the S&P 500 coming out of its earnings season, 75% down the track. That is reasonable at 243.5, 244 EPS for the S&P 500. That is a reasonable environment for 1 year forward for equity. So Nikkei and S&P 500, reasonable, notwithstanding the hedge funds and the volatility got what they wanted. And by no means is it behind us, but the severity and the degree of it, we believe, is behind us.
What do you make of Japanese financials? There was a lot of optimism coming into this year given the tightening of the BOJ, but then you see these U.S. recession risks and yields getting crushed. We have seen immense volatility on the Topix Banks Index, and it's still down today as well.
Yes, that's yet to play out, and there'll be some margin pressure in the out years. But again, getting through the volatility, Japanese financials still seem in a reasonable situation relative to where they've come from. That's the thing to reinforce. And obviously the volatility in bond markets has been the extreme component, just like the volatility obviously in currency, and that's obviously scared a lot of value investors away or fundamental investors away, trying to understand the mechanics of it. But very quickly, you get this inversion of the yield curve, and you get this flattening of the yield curve in the last 2 days, particularly in the US. And the signal, and then the backup of yields in the US from those severe lows that you saw on Monday, with that obviously correlated highly, which is traditional in recent years, with that yen weakness in the short term. So my answer to that is timing. So yes, financials in Japan are reasonable going on a 1 to 2 year view, but we're going through this extreme volatility event at the moment, and we'll just have to see what happens to the margins with this severe currency move as it's playing out for the Nikkei, the implications for the index and the earnings for it.
George, how healthy is the U.S. economy right now? I mean, all of these gyrations in the markets really coming after the U.S. jobs report, surprise to the downside. And of course, we have the BOJ rate hike as well. But I wonder, given that we are even seeing pressure on Chinese exports, if the weakness in the economy in the U.S. will see global ramifications, especially hammering the second largest economy even more when they're trying to really come out of their home property slump.
Yeah, so very quickly, it is an oversimplification. The US economic environment is in reasonable shape. Yes, the leading indicators are contracting. It is very bumpy. It is uneven. And last Friday night was just 1 month's data, and that is what high persistent discount rates is all about. It's creating that demand destruction which is working its way out into the economy. But it is in reasonable shape relative to the restrictive monetary policy. Earnings are expanding. It is very uneven, of course, and notwithstanding some of the leading indicators, you can summarise the US economy and middle America and industrials and healthcare doing reasonably well. And with the prospect of rate cuts starting from September in a measured manner, and the thing to reinforce, regardless of what the commentary is, no intra-meeting moves, and a shallow rate cut cycle means you get 100 basis points over a year's time. You're not going to get to those low levels when we're conditioned for. And I think the US economy can withstand that. It is resilient enough across the board for a shallow interest rate cut going forward. The earnings are reflecting that, and credit conditions, particularly the investment grade credit. And those sub-investment grade, they're obviously finding it very difficult in that correction, and there may be some problems in there over the next 3-4 months, but reasonable credit conditions as well for the US 1 year forward. Very quickly on the trade, NAFTA is the beneficiary of it, so Mexico relocation and Canada for trade and export, and China's going to go into a world of pain in its very successful export sector. It's got very bad domestic demand mechanisms, very bad weak consumer and business sentiment for obvious reasons. It's going through the biggest adjustment in a property construction cycle collapse. It's successful in the export sector. It just has to pivot away from that US competing area, and it will find other markets.
George, I wanted to ask you further about the outlook for treasuries, right? This is our MLive blog question of the day. Have we seen the low point when it comes to treasury yields? And is that sort of 3.665 where investors will be looking at for the rest of the year? Does this really depend on, you know, what the next sort of couple of reads on inflation comes in at too? Yeah, no, good question. Very subjective comment now. In the very short term, I think 360 is the low for the 10-year. For the next 2-3, like very short-term trade. But by next year, you'll get the test of those 360s before March quarter, before the March end next year. Very quickly, is that it was an extreme unwinding, short vol that got to that event. The 3-year bond auction was reasonable. The 10-year last night, just a bit messy. We'll see how the longer bond auctions go. But in the very short term, the lows of yield are behind us. We'll revisit those in calendar 2025. But there's going to be many moving parts, and the core inflation is stubborn, but it's behaving the way it should be, and the Fed commentary
is sensitive to that, but obviously wants to start that rate cut cycle. But the sheer issuance of treasuries required in the long end. And very quickly, why wouldn't you have issued as much as you can under 4% for long bond yields in the US, given the inversion from cash? Notwithstanding the 2 10-year flattening at the moment suggests that the US economy is in reasonable shape to withstand these tighter conditions, expecting the rate cuts to start in a slow and measured manner.
George Babur, as always, good to have you with us, Managing Director for Research, Investments and Advisory at K2 Asset Management. We have more ahead on the Asia trade. This is Bloomberg. And it's a broad down day for the Asian session today, but some of the big movers that we're following at the moment, BHP, the world's #1 miner, planning to sell Brazilian copper and gold assets that it acquired with the takeover of Oz Minerals. This is according to people familiar with the matter. We're also following Qantas Airways after it conducted a governance review and found that while there were no findings of deliberate wrongdoing, mistakes were made in management, and the former CEO, Alan Joyce, will have his remuneration reduced. We're also following SoftBank because they really reporting a smaller net loss in the June quarter than a year ago and announcing a buyback as well. But you can see right now continuing to lead those losses by almost 3% after that wipeout that we saw on Monday of $15 billion by the group's market value. And also Tokyo Electron down more than 3% ahead of those earning results that we're going to get later today. But let's get more on the outlook for the earnings and bring in our tech reporter, Annabelle Drewlers, because, Belle, the expectation is a little bit for stronger numbers out today, but given the down day today, it's still losing ground.
Yeah, it's actually quite interesting, as you said, a drop of nearly 4%, but actually the expectations for Tokyo Electron are pretty solid. So operating profit, for instance, that could be up around the 50% mark, income of around 130 billion yen, net income about 95 billion yen. It has been, though, quite a whipsaw period for the company, and perhaps that share price reaction just kind of points to that today. Just in the past 3 months, I mean, the stock's been moving around that 20% mark range. And question marks really, would the White House look to impose further restrictions? There's been stockpiling as well. We had from China that happened at the end of last year of its equipment. But as we said, the numbers looking pretty solid for today, and especially when you take its peers in this space, like Lam Research, for instance, as a guide, it should be pretty good today.
But what about demand from Chinese customers?
Well, that's been kind of the big question mark. And as I said, one of the questions in the past reporting period was whether we would see further export restrictions. That doesn't appear to be the case. And actually, when you take a look at the financial analysis of Tokyo Electron, you can see that about 45% of its revenue is being derived from China. Speaking to our Bloomberg Intelligence team, they're expecting that sort of range to stay in place, maybe dipping down to around that 40% mark, but 40 to 45% mark. China will remain a major market for Tokyo Electron's products. And we know, of course, China remains so focused on building up its chip-making capabilities.
And yet, when we're expecting SMIC's results later today, we might see some weakness.
Yeah, that's right. It's a bit of a different story, actually, for SMIC. It is the largest listed chip maker in China. Taking revenue guidance, for instance, we're expecting around an 80% drop in net income. Net income around that $76 million mark you can see there. Revenue's still growing, and that expectation of around $1.8 billion. But SMIC is facing challenges here on a couple of different fronts. Firstly, it's spent a lot on expanding over the past couple of years, so those capex costs are really starting to weigh now. There's high depreciation that's coming through. And there's also really stiff competition in the low-end chip market where SMIC is also looking to compete domestically. Legacy chips, so they're things that are used in PCs, smartphones as well, they're really not nearly as expensive to buy, and they're also not nearly as complex to produce. So there's a lot of competition in that space, and as a result, SMIC's margins are being pressured here. So certainly in the earnings call, Haidi, we're going to be looking for any sort of indications we're going to see pricing improvements in the second half of this year.
Tech reporter Annabelle Drula is there, and we'll also be watching the sort of digesting of SoftBank's earnings and the buyback with Astris Advisory Japan later in the show. We're seeing SoftBank off by 1.6% despite ADRs rising by the most since July 5th after they announced that $3.4 billion buyback. Really seen by a lot of analysts as being a positive implication, given that's the first buyback for the first time in 2 years. Let's take a look at China now. The PBOC may be closer to a dose of monetary stimulus that have been long awaited by investors and traders. Some economists are expecting 3 rate cuts in total this year. Our China correspondent Min Min Lo joins us now in Hong Kong. So what are the signals that potentially that suggest that finally some of this respite is on the way?
Yeah, well, more economists are expecting the PBOC to make at least 2 more rate cuts before the end of the year after the surprise rate cut in July. And that's mainly because, I mean, if you look at the yield gap between the US and Chinese 10-year government bonds, that is at its smallest now since February. And the Treasury bond rally has really pushed down yields and taken some pressure off the yuan. For more than a year now, the PBOC has had its hands tied trying to defend the value of yuan. And this is now a big window of opportunity for the PBOC to cut. Especially the big game changer would be if the Fed does go on this aggressive easing cycle to stave off fears of a recession. So some economists expecting the PBOC to move even as soon as within a few weeks. And of course, we are seeing that very soft export numbers that came out yesterday suggesting that global demand for Chinese exports could be softening. So the economy does need more stimulus, especially on the demand side domestically, and hopefully, more rate cuts could encourage more households and businesses to begin spending and investing again.
China's biggest lenders trying to lock in those cheaper rates. What are we seeing in terms of levels of debt that they're issuing?
Yeah, some of China's state banks, the largest ones, are issuing debt that are upwards of 100 billion yuan. And this is happening because they're trying to lock in the very cheap interest rates, but also because of regulatory requirement as well. These banks, the G-SIBs, the globally systematically important banks, are required to increase their total loss-absorbing capacity to 16% by January and to 18% by 2028. And on top of that, they also have some capital buffers that they need to meet under the Basel Accord by next year. So the total funding gap is estimated to be about 1.6 trillion yuan. That's according to Fitch Ratings. And that's why these banks are trying to raise funds. There are several ways for them to do so. They could issue stocks. They could use retained earnings. But we've seen profit margins really been razor thin this year because of the low interest rate environment and the weak economy. Whereas when it comes to debt issuance, that's boosted by 1.1 trillion yuan in callable debt in the banks. And that's why many banks have been looking to refinance. The average coupon rate is around 2.75%. And so that's why you're seeing investors also very willing to absorb them because it's pretty good, solid returns, better performing than the sovereign bonds. And there are not a lot of high yielding alternatives in the market right now.
Goldman's, in the meantime, saying that China's overcapacity situation could improve in the next few years, although not for EVs and steel.
That's right. So Goldman Sachs had came out with a report. They studied 7 manufacturing sectors in China that make up nearly a quarter of China's economy. And their conclusion is that China is producing at a capacity that is greater than global demand in 5 of these 7 sectors. So in the chart that we're going to pull out, you can see that the prices for solar panels and lithium batteries, that's dropped significantly in the past year. Those 2 lines at the bottom, the red and the blue, has dropped a lot. That's because China is producing at a capacity of 200% of global demand when it comes to solar panels and 150% of global demand when it comes to lithium batteries. And that oversupply has cut prices by more than half since early last year. So just from a demand and supply perspectives, companies are not going to see it as so lucrative to invest in more capacity. So the expectation is that market share, Chinese market share of overseas supply in these 2 sectors are likely to drop by about nearly 20% in the next couple of years. But when it comes to EV, that's the orange line there in the middle. You see prices just dropping slightly. And the other sectors, aircon, construction machinery remaining quite elevated, and that's why the estimate is that China will continue to see an increase in market share by 4% when it comes to aircon and EVs. Goldman Sachs also said that this overcapacity is not caused by government subsidies. They said subsidies only make up about between 2 and 10% of operating costs, but instead it's because of China's huge size of its economy and the huge pace of this market swings that makes it very difficult for companies to estimate global demand, especially when it comes to emerging new sectors. So it takes a while for the market to match itself when it comes to the supply and demand alignment.
Bloomberg's China correspondent Mimi Lo there with the latest on China. We have more Asia trade. This is Bloomberg. This is the Asia Trade. Let's get to some of the top market calls this morning. JP Morgan CEO Jamie Dimon says he's skeptical that inflation in the U.S. can return to the Fed's 2% target. He told CNBC there's still a lot of economic uncertainty tied to factors including geopolitics and quantitative tightening. Dimon has been warning for more than a year that inflation may be stickier than investors expect and says his bank is prepared for rates ranging from 2 to 8% or more. Meanwhile, JP Morgan economists say they now see a higher chance of recession in the U.S. by year-end. They raised the odds to 35% from 25% last month. The team says recent data suggests a sharper than expected weakening in labor demand and early signs of job shedding. JP Morgan's call follows that of Goldman Sachs, which now sees a 25% probability of a recession in the next year. Heidi.
And Shery, Goldman Sachs strategists think U.S. yields are too low because there's little evidence of labour or financial market dysfunction. They add that a meaningful rally can only happen if one or both of those risks materialise. And U.S. Treasuries are under pressure after investors spurned that sale of the 10-year note auction that was offered at lower yields. And that's really kind of our question of the day. Is this a low when it comes to this year for Treasury yields? More ahead on the Asia Trade. This is Bloomberg. About 30 minutes into trading in Asia, the top stories you should know. Japan's markets are firmly in focus. They become the centre of worry for global investors, especially following yesterday's dovish BOJ comments. Weak demand for a sale of 10-year US Treasuries also underscoring the current fragility of global financial markets. Upcoming earnings from Asian chip companies will provide investors more clues on the direction when it comes to tech stocks. Tokyo Electron and SMIC report later today. They're expected to show contrasting results, painting a more nuanced picture when it comes to demand for tech. Shery.
Heidi, take a look at how Asian markets are trading right now, because we're seeing a sea of red with the Nikkei falling about 1.5%. Of course, we have seen this incredible volatility in Japanese assets, especially as the Japanese yen strengthened and weakened and is now strengthening again. Take a look at the Kospi as well, down more than 1%. We had seen it boosted in the previous session by the likes of Samsung, for example, on that AI related story with NVIDIA's test being passed by its advanced chips, but we're not seeing the support right now. Take a look at some of the big movers, because on the topics we're watching those financials again losing ground, and this of course coming after we saw the optimism when it comes to those financials because of the BOJ rate hikes, but at the same time now fears of a U.S. recession leading to that sharp decline in U.S. bond yields, offsetting the impact of the BOJ and crushing Japanese yields as well.
Yeah, and Shery will continue to sort of monitor some of the big moves as we get into those earnings numbers, right? SoftBank is kind of the surprising one, given that we had that big jump in ADRs overnight on the buyback news, but not seeing such a great reaction in the cash session today. A lot of the analysts sort of reaction has been quite positive, though, given that's the first buyback for the first time in 2 years. It still, though, leaves Masa with a substantial pile of cash as he gears up for more aggressive investments into AI and semiconductors. Let's get us some analysis now with Kirk Boodry, who's of Astris Advisory Japan. Kirk, great to have you with us. So, are you surprised to see the negative reaction? Is this more, I guess, speaking to the broader volatility and the fragility of sentiment than it has to do with the SoftBank story itself? Because the buyback, I think, was a pretty positive signal for most people.
Yeah, I'm a little surprised. I mean, because the buyback was positive news. I mean, one of the reasons why SoftBank is trading down at this level is because the discount's so wide. It's at 51%. I mean, that's near, the sort of outer end of the range that it's been at. Having said that, a lot of how SoftBank trades is driven by ARM. And so ARM and NVIDIA, they're both down 5% overnight. So that has an impact as well. I think also one of the issues that, the shares are facing coming out of the earnings report is the outlook for the markets generally. So when you look to what the company is going to do over the next year, part of it depends on them being able to monetize their holdings, sell things that are in Vision Fund now, bring companies to market, and there's uncertainty about that. So independent of whatever SoftBank said today, there is a bit of hesitation on the part of investors.
What do investors need to hear from SoftBank at this point, then?
Well, I mean, it's, good news on IPOs coming out of Vision Fund. I mean, we have some small companies that are going public in India, like Ola Electric and First Cry. Those are, positive for monetization. But, the bigger, the heavy hitters, I suppose, within, the private Vision Fund portfolio, like Inolja in Korea for Vision Fund 2, ByteDance in the US, which is a bit of a stretch to think that could go public. Fanatics, all these companies would represent a real sort of step forward. But it's hard. Again, it's out of their control. The message that they're putting out is that, the IPO market can open up towards the end of 2024, the beginning of 2025. Anything that they have to say on that, from their view, that brings that timeline forward, or at the very least firms it up, would be positive, we think.
Kirk, how much does exchange rate volatility, with really the yen going up and down at the moment, factor into SoftBank at this point, given all of its global investments?
Sure. I mean, it's, SoftBank on a yen basis is definitely worth more when the yen is weak or when the dollar is strong. I mean, 80% plus of their assets are dollar linked or dollar denominated. So in that sense, a stronger yen does mean that the Japanese, the SoftBank listing, Japanese listing, is probably going to feel pressure from that. I mean, one thing that I thought was an important message that may not have been fully realized coming out of the earnings is how they believe that their balance sheet is, still very defensive. So they talked a little bit about loan to value, being 8% at the end of June when the quarter, using the quarter end numbers. But if you pro forma, if you use pro forma numbers for exchange rate and pricing, that loan, after this last week's volatility, that loan to value rate is still 10%. So on one hand, just mathematically, a stronger yen does mean the Japanese share price is lower. But on the other hand, concerns that this may impact the balance sheet in a meaningful way are probably overdone.
Kirk, as you point out, the messaging when it comes to their AI investment strategy is still sort of being fine-tuned, right? How precarious is it? Because this is, that focus comes at a time when broadly investors and markets are losing their patience with, somehow the sudden realization that the invested capex has not quite correlated to returns.
Yeah, I mean, there's two ways to look at that. I mean, SoftBank, their strategy moving forward, this is a sort of mid to long-term view as opposed to what's happening in the near term. And they look at the areas that they think they can invest in. It's data centers, it's AI chips, and it's robotics. And those are all areas that they already have strength in, and they believe that they can develop that further. These are not investments for the next 6 months. These are investments for, the 3 to 5 years or beyond that. Now, one of the positive factors may be that if you have a lot of concerns about AI, that we're in a bubble, some of the valuations will come down across the board, not just for public assets, but private assets as well. And that may help them get in early and at a decent price relative to what they would have otherwise. I think when you look back at what they've done when they've had cash in the past, I mean, when they had Vision Fund 2 and they were selling all the assets in Vision Fund 1, they were buying at the top of the market, in 2020, 2021, and they're still trying to get out from under that. But it may be different with this pivot to AI.
The GraphCore acquisition was interesting, right? They're clearly interested in exploring, vertical integration within that complex of AI. Does that mean we should expect to see more collaborations with the likes of ARM?
Well, I mean, GraphCore and ARM are a natural sort of combination. They're not talking about how those two companies can be put together. We've heard that in the past that any efforts that SoftBank makes in going after the graphic processing unit, the GPU market, as opposed to the CPUs that ARM does, would be done through ARM. It seems like it would be a natural fit.
Kirk, great to have you with us. Kirk Boodry, who's the analyst at Astris Advisory Japan. Investors will also be watching Kweichow Moutai's first half results due later. The liquor maker is seen really as a barometer for Chinese consumer sentiment. Bloomberg Intelligence senior analyst Ada Lee joins us now for a preview. Well, given how poor consumer sentiment has been, or how weak it has really been, what do we expect from Moutai's second quarter numbers?
Thanks, Heidi. So for Kweichow Moutai's second quarter earnings and sales, we believe that the company could deliver a mid to high teens growth for both metrics. And this is much slower than the early 20% growth we have seen in last year's second quarter, perhaps reflecting the slowdown in consumer demand in China.
So what can we expect then going forward?
So going forward, we actually believe Moutai could remain robust in terms of its earnings for 2024. The company has set out a 15% sales target for this year, and we believe that so far the company should be able to achieve that for the end of this year.
Do you think wholesale prices are going to continue to be a challenge?
Yes, we do believe that the wholesale prices, which we have seen a slump since the end of June, could remain, in range bound at the current level. And it is actually quite tough for the market at the moment in terms of, looking at the wholesale prices and seeing where it's going. But based on our analysis, we found that the high level of in-market inventory could remain a drag to the rebound going forward. So based on our calculation, we think there is about 77 million bottles of Fei Tian Moutai available in the market as an in-market inventory, which are products that have been produced, sold by the company, but not consumed by the consumer. Given the high level of in-channel inventory, we think the rebound in wholesale prices could remain challenging.
our Bloomberg Intelligence senior analyst Ada Lee there with the latest. And of course, we saw Moutai potentially being affected by that weakening consumption in China. Well, one stock that we're watching today in the Japanese session is Shiseido as well, because it reported the first half operating loss of more than 2.5 billion yen. They posted an operating profit loss, and that was really to do with weaker Chinese demand. And you can see the stock taking a big hit there. Continued decline in Chinese consumer confidence, negatively affecting travel, retail, and China market segments is what has been pinpointed by the CFO as being the reason behind this disappointing result. We're also watching on the other side of that story, Laser Tech, for example, which is now rallying in the Japanese market despite the broader down day, because the Japanese semiconductor company reported strong fourth quarter results from record orders, and you can see the best day for the stock since 2015. We also have more reactions from earnings. Asahi Group posting its core operating profit guidance with a little bit of a boost for the full year, and the guidance beating the average analyst estimate. And Isuzu also reporting operating income for the first quarter that beat the estimate as well. This is Bloomberg.
We are seeing a little bit of weakness when it comes to Qantas shares. Of course, it is a broadly down session after 2 days of gains for Australia's flag carrier. And in fact, we're trading sort of at a little bit of a 1.4% lower at this point. We did hear that the Qantas board has decided to cut the final annual pay packet of its former CEO, Alan Joyce, by about $6 million following a review of governance. Our global business reporter Angus Whitley joins us now for more. So it's interesting because we were just chatting. Alan Joyce was very well supported by shareholders in terms of his turnaround plan for Qantas. So what's behind this his pay being docked?
That's right, Heidi. He was, I know it's a cliche, but he was I suppose, a proponent of investors. He delivered huge dividends and stock buybacks and bumper profits for investors, but he retired, or he didn't retire. He left the airline prematurely in September last year after a string of crises. You remember last year in the wake of the pandemic, there was accusations that Qantas had sold tickets on ghost flights or flights that it had already cancelled. Joyce led the airline when it sacked 1,700 ground staff illegally. And also, as it recovered from the pandemic, there was a huge jump in flight cancellations and lost bags. And so really, this governance review that Qantas released today was looking to analyze the reasons for that, and also decide whether or how much Joyce should sacrifice from his final pay packet. And the decision today, I think, is acknowledgement that the board and Joyce failed to some degree customers and staff, and they got that balance wrong, as you said, between customers and staff and shareholders and profits. And Joyce sacrificed about just over 9 million Australian dollars. That's almost half of his total stated payout last year. So that's a statement in itself. And then coinciding with this, the stripping of, or the docking of Joyce's pay to that degree, is also this governance report that Qantas released today, that in itself is a transparent step that perhaps Qantas wouldn't have taken under former leadership. But this review looks at the way the board reacted to the pandemic and the decisions that the board took, and also Joyce and management took after the pandemic. And it found that there were a series of failings there which really contributed to the reputational crisis that Qantas is still suffering from to this day. And so they've decided to take some steps there. They've tightened up management procedures, they've refreshed the board, and they're adopting all 32 recommendations in this internal business report, which they've released today.
So I was going to say, where does this really leave Qantas then? Where do they go from here?
As the report said, it's not yet fully recovered from this crisis. And there are plenty of passengers out there who still feel aggrieved by Qantas, the passengers perhaps who found it impossible to recover their COVID credits, their flight credits from Qantas, who were let down by cancelled flights or lost bags. So Qantas still has some way to go to recover that trust and get that balance right, I think, between profits and customer satisfaction. And I don't think it's clear yet whether Qantas can reach that same height of profitability and profits as it did under Joyce, as it now does under Vanessa Hudson. So Hudson has to find a balance, and the board has to find that balance as well.
Global business reporter Angus Whitley there on the latest on Qantas. Let's now turn to India and our exclusive series on the next generation of leaders being groomed to run India's $213 billion Adani Group. Jeet Adani is the youngest son of the conglomerate's founder, Kweichow Moutai, and heads their airports and defense businesses. The 26-year-old was a relative newcomer when short seller Hindenburg's allegations of fraud rocked the group last year. We asked him how that period impacted him and his family.
Jeet Adani is the youngest son of Indian billionaire Kweichow Moutai. As part of the tycoon's succession plan, the 26-year-old engineer is overseeing the running of 7 airports across the country, including the one in India's financial capital, Mumbai. The Adani Group is also building a brand new airport for the city at a cost of $2 billion. Along with airports, Jeet is responsible for the defense business, while also looking after the group's digital initiatives. The youngest of the next generation of Adani leaders is being groomed to run big parts of an empire that's been rocked in recent years. In early 2023, just a few years after Jeet joined the family business, a report published by short seller Hindenburg Research accused the company of fraud and share price manipulation. It sparked a $150 billion meltdown in shares of group companies. The Adanis have denied the allegations, and their shares have recovered, but they're still dealing with the fallout. Bloomberg's Anto Antony spoke exclusively with Jeet Adani and asked him how the group's strategies have changed.
You had just joined the business when the Hindenburg report came out. How did it affect you personally, and what role did you play in that crisis situation?
I think it was definitely, personally speaking, a very stressful and tough time. Emotions were high. But I think the most important thing that was on my mind definitely was, what can I do to support, obviously, the family? But more than that, how do I support the larger family, which is the employees? Because the biggest risk that you run in times like these is demotivation. People, sort of losing hope. And to make sure that everyone is motivated, everyone knows that what we are doing is for a greater purpose. It's for, we're making real impact, and we continue day on with the work, because these things, they happen, they come, they go. But we don't want to lose motivation.
Some of the investigations or probes or allegations are still an overhang on the group. How are you assuaging the investors' concerns in these times?
So I think, and this is based on some of the interactions that I've also had with investors over the past couple of months. I think there's a clear understanding with the investors that, with the Hindenburg report, everything that was said and allegated against us was sort of just rehashing old things again. And a lot of investors really appreciated the kind of communication that we've done over the last 18 months. At the end of the day, not a single investor's query will be left unanswered. We were proactively reaching out to investors after each and every report or article or anything that was coming out. And with all the performance from the financial side also, they were very clear that, look, this is a very good asset. All of the companies, they have strong infrastructure assets, and the leadership team has given us enough confidence by communicating with us enough. I think that's kind of helped actually investors to realize that, to look beyond this and actually look at the asset, look at the leadership team, what kind of cash we're generating, and what kind of growth we're doing.
Jeet Adani, the youngest son of Indian billionaire Kweichow Moutai there. Our special coverage of the Adani Group culminates with a special report on Friday at 11:30 a.m. Hong Kong time. There's an encore presentation at 7 p.m. or 4:30 in the afternoon if you're watching in Mumbai. More ahead on the Asia trade. This is Bloomberg.
Take a look at how markets are trading across Asia right now. It's really a sea of red when it comes to the equity space, with the Nikkei and the Topics now losing more than 1%, and the Kospi also down more than 1.5%. When it comes to volatility in the markets, a little bit steady for the Japanese yen at the moment. A bit of gains against the US dollar, but still at that 146 level. Of course, we're still trying to digest the latest BOJ minutes as well, with one member saying that prices and growth are developing in line with the outlook. We also got their current account surplus narrowing more than expected. We continue to watch Haidi, of course, the tech sector, which has been a big player in these gyrations globally.
Yeah, and to that end, we continue to watch some of these tech-heavy markets, the likes of Taiwan, right? We've got some key earnings across that space, including SMIC, and a closer eye than usual when it comes to China. A lot of weakness being shown across the futures picture there, but some questions when it comes to the PBOC's potential easing path. If the Fed chooses to move more aggressively than expected, economists are seeing that potentially the PBOC may have to move towards giving more respite and rate cuts to the economy as well. So kind of bringing closer that dose of stimulus that China investors have been so waiting for. That's it for the Asia trade. Our markets coverage continues.